When I was a math professor, I worked with a colleague who always would come into my office and say, "Great news." I have a way of looking at this problem we're working on such that if we work this out, we either get a proof or a counterexample. Either way, we win. Well, I like to think of no arbitrage relations as the same thing. If there's no arbitrage, we get a formula. So we win, mathematically speaking. That's great. If it's violated, we make free money. Also good. Either way, we win. Hi, everyone. I'm Doug Costa. I'm a quant here at Susquehanna. My background is in mathematics. I was an undergraduate math major and then went on to get a PhD in math, specializing in abstract algebra. That was in 1974, and at that point I was lucky enough to get a position as a professor in the Department of Mathematics at the University of Virginia. Over the course of some years, and through a former grad student, I wound up doing some consulting for Susquehanna in 1993-94 and a couple subsequent years, and developed a very strong relationship with the partners in the firm, and came here full-time in the middle of 1997 as the head of the quantitative research department. I held that role until about around the middle of 2015 when I transitioned into a role in the education department. So today we're going to focus on a basic introduction to option pricing theory, to derivatives pricing theory, and what makes it work. It'll be pretty elementary, but the main point is to give you the idea behind it. So we're going to also talk in particular about calls and puts as examples, but basically, what is a derivative security? A derivative security is a financial security or contract, but which is deriving value from some other underlying security. And typically, that's a stock or an index, but it could be almost any asset. It could include currencies, it could include commodities like gold, silver, oil, and so on. It could even include temperature. There are such things as options on temperature, called heating degree and cooling degree day contracts. And for more exotic things, you could have options or derivative securities based on snowfall at a particular location, etc. Okay, so it's a fundamental principle of Finance 101 that the value of a contract or a business project should be the discounted, in other words, the present value of all its future cash flows. And those cash flows can be positive or negative, inflows of cash, outflows of cash. So the basic principle is the value of something should be the sum of the discounted future cash flows. Well, an interesting phenomenon is that for derivative securities, that just doesn't work. And so our goal today is to see why and to see what does work and give you some beginnings of how to get started on derivative security pricing and options in particular. Okay, so let's get started. Calls and puts. So if you're not familiar with calls and puts, a call option on a stock or an index or currency or whatever is a contract which gives the buyer of the contract the right, but not the obligation, to buy the asset, so in this case the stock, we're talking about stock options, at a specific future time t for a guaranteed price k. So notice that's quite advantageous. You're getting a guarantee that you can buy it in the future when we don't know what the stock price is going to be at a price that we agree on today, we set today. The time at which this is going to occur in the future is usually referred to as the maturity or expiration of the option. And the agreed price is called either the strike price, the option is struck at that price, or the exercise price, because the buyer has the option, the choice, whether to exercise it or not. In other words, exercise that option. choose to buy it or can always choose not to buy it. A put option is the exact same thing, except it gives the buyer the right to sell the stock or the underlying asset at time t at a fixed price k. Now, there are two styles. I'm going to go a little back and forth here. There are two styles of call and put options. A European call can only be exercised at maturity t. So in other words, from the time you initiate the contract, so you buy or sell the call, nothing happens until maturity t. And then the decision is made whether to exercise it or not. But an American call is a different style in which once the contract has been signed or the option has been sold and purchased, then the option holder can exercise that right to buy or sell at any time up to and including expiration. So because this is giving the option buyer quite an important right and some kind of value embedded in that, the option buyer always pays a price, the premium, to the seller, and the seller keeps the premium. No matter what happens, that money belongs to the seller. But in the end, if and when the buyer chooses to exercise the option, the seller must perform obligations to either sell the stock to the call purchaser or buy it from the put holder. Okay, so I just wanted to note that in the European option case, at maturity, the payoff to a call buyer looks like this. It's the maximum of the future stock price, which we don't know today, that's a random quantity, minus the strike price or exercise price. It's the maximum of that difference in zero. Why is that the essential value? Well, because the call buyer will look at the situation and say, okay, I have the right to buy stock for K. If the stock price is below K, then I can go buy it in the market cheaper. So I'm not going to exercise that right because that would be kind of silly. I would lose money. But if the stock price is higher than K, then yeah, the call buyer wants to exercise that right because I can get the stock today at a discount, and if I wanted, I could immediately sell it. But at least I have this amount of value. Whether I sell it immediately or not, I have that value as T minus K. So the max reflects the call option holder's option, the choice to choose whether I get zero or a positive quantity and therefore never have to suffer a negative quantity, a loss. The payoff to the put buyer is the opposite. It's the maximum of K minus ST and zero, for obvious reasons, because you have the right to sell. So you will sell for the high price if the stock price is lower, but if the actual stock price in the market is higher than K, you wouldn't sell to the person who sold you the put. You would sell it in the market. Okay. So that's the idea of calls and puts, and they are derivative securities because their value depends on the value of the underlying stock. There's a tight relationship here between a call or put value and the future stock price value. Okay, so now the payoff I'm going to refer to as f of st because it's some defined function. Just to fix this in your mind, notice that the call payoff at maturity is going to look like this for strike K, where the horizontal axis here represents all the possible values of the future stock price ranging from 0 to infinity. Same thing over here. And so the maximum of st minus k and 0 is a function of st that looks like this. As a function of st, the put payoff looks like this. And let me just mention again that Peter Carr, who was a wonderful quant, and I was privileged to know him, was a big hockey fan, having grown up in Canada, and he used to refer to these pictures as the hockey sticks, these payoff functions. Okay. Now, if we were going to try to evaluate the values of puts and calls using standard probability and math and Finance 101 principles, we would say, well, we need to know the stochastic process for the stock price. The underlying stock price, stochastic means random, by the way, in case that's unfamiliar to you. The stock price follows a random process. In the future, there are infinitely many random paths that the stock price could follow. And a priori, we don't know which one of those it's going to be. I've drawn a schematic picture here in which I've illustrated some of the possible random prices. There are infinitely many, a large infinity, uncountably many. And maybe the red one is the one which will ultimately be seen to have occurred looking backward from time t, but we don't know ahead of time what that's going to be. So this stochastic process for the stock price is a stochastic process which is really the set of all possible paths, or for each fixed time I could draw a vertical axis here and slice the paths, and I could basically count how many end up at each point on this and get a probability distribution. So here I've illustrated some kind of probability density function, the PDF, of the future stock price, which we could infer from the probability distribution on this set of all possible paths. So once we have modeled the stock price process, all these paths, we can then infer what this probability density function will look like for the future stock price. And I'm going to call that g of st, so as not to confuse it with the payoff function f of st. Well, in standard probability and mathematics, you would say, well, okay, I have a future stock price. I have a payoff function, which is a function of that stock price. I would like to know the expected payoff, the expected future cash flow. I can calculate that by using the probability density function to calculate the expectation. And then I would discount that to the present to figure out the value. So using Finance 101 principles, we calculate the expected payoff, that's E of f of st. Since we know the probability density function from our stock price process model, that's the integral from 0 to infinity of f of st g of st dt. And here, of course, we're making the very reasonable assumption that stock prices exist in a range from 0 to infinity. So, according to Finance 101, F0, that's the value of the derivative security right now, times 0 I always think of as now. The security value now should be e to the minus RT, where R is the risk-free rate or the money market rate that you can get by investing funds in a money market account, or SOFR, or whatever you want to choose for that risk-free rate. It should be the discounted expected future payoff. But remarkably, the answer to this question is no. If we say, should this be correct? Answer, no. And our goal today is to understand why that's the case and begin to get a sense of what is correct. So first, before we get into the fundamental principle that drives all this, I want to just look at a discrete time approximation of a stock price process, because I want to make this as easy to grasp as possible. So I'm going to discretize the stock price process so we don't have to get into some fancy stochastic calculus today. Okay, so what I'm going to do is represent the stock price process by what I call a recombining, or people universally call it a recombining binomial tree. So what we're going to do is take our time to maturity, the time interval from 0 to expiration of the option, and divide it into n equal parts. So delta t, I'm going to call the lengths of each of these time intervals delta t. Delta t is going to be capital T over n. So t is n delta t. It's the nth time step. And I'm going to think of this as the first time step, the second, etc. Okay, and within each time interval, we're going to postulate that the stock can either go up or down. It can only do one of two things, move up or move down. And the same thing at the second time step. Once we get to this point, which I'm going to call a node of this tree, it can either go up or down. Now, recombining means if we go up and then down from a certain starting point, and we go down and up from that starting point, we get to the same place. What is the reason for making this assumption that the tree recombines, or forcing this assumption on our model? Well, we could just let the binomial tree split each time, and if we were to do that, notice we would get 2 nodes here, but then at the second time step, we'd get 2 here and 2 there. That's 4. And then the next time step would be 8, and we're getting powers of 2. So we would have 2 to the n nodes at the end, terminal nodes, I call these. Well, that's a computational issue. We're going to want to use these trees to price calls and puts and other derivative securities. And that's computationally too complex, too slow. Trading has to be fast, models have to be fast, we have to compute option prices quickly. By making it recombine, notice what happens. At the first time step, we have 2 nodes. At the second, 3. And so at the nth time step, n plus 1. So it's linear growth in the number of nodes instead of exponential growth. N plus 1 versus 2 to the n. So this is very computationally feasible. Linear growth in the computation, no problem. Very fast. So these are very, very efficient ways of computing option prices. Of course, you want to use n to be kind of realistic. N should be a large number. Now, I'm going to label the nodes in the tree as follows. So this is S0, the price of the stock now. You know, we kind of pretend we know exactly what the price of the stock is to start with. But there's really a bid-ask spread, so it's somewhere in between those. But we'll assign it a price. And then at the end of the first time step, we're going to have 2 prices. So I'm going to label them S10, that's time step 1 and node 0, the bottom one, and S11, time step 1, node 1. And then at time step 2, it's going to be S20 for the bottom one, 21 for the next one, 22 for the top one, and so on. So I have all these Sij's in here. And then, in order to make it into a stochastic process model, I need to introduce probability, the measure of randomness. So I'm going to have P11 be the probability of going up in the first time step, P22 being the probability of going from S11 to S22, P21 the probability of going up from S10 to S21. Now the probability of going down, because these are probabilities and there are only 2 alternatives, the 2 probabilities have to add up to 1. So we know what the probability of down is. It's 1 minus Pij. So at each node, you've got an up probability, Pij, and a down probability, 1 minus Pij, which I'm going to refer to as Qij. Well, by filling in this picture, by making choices, we are free to make choices about how to spread out these stock prices at each of these nodes, and we're free to choose the probabilities that we want at each node. We can approximate discretely almost any continuous stochastic process for the stock price. So this gives us a lot of flexibility. Okay, so here's an important point to keep in mind. The vertical spread between 2 nodes at the end of one binomial step basically determines what we call the volatility of the stock at that time. Volatility refers to the standard deviation of returns. So how is it that that works? Well, just using elementary probability, if you have a random variable, this is like flipping a coin, but where the probabilities are P and Q, where P and Q add up to 1, of course. And the 2 values you're going to get by flipping the coin are S up and S down. So I'm looking at one abstract time step from the middle of the tree somewhere, just a generic time step where the price at the beginning is S, and when you go up it's S up, and when you go down it's S down. You can just do an elementary calculation to calculate the standard deviation of the new stock price, the random stock price after one step. And it's the square root of PQ times S up over S minus S down over S. That's the standard deviation of the return, the arithmetic return. So notice it's just completely determined by the difference S up minus S down. So that spacing that you put in there will determine the volatility at that little point, that local volatility. I just want to point out here that in the Black-Scholes model, if you want to get into that, we're not going to go into detail about it today, but the way to discretely model the Black-Scholes model is to choose two fixed numbers, u and d, both positive, u bigger than d, and in your model to make every up move a multiplication by u. So this is actually multiplication, and every down move a multiplication by d. Notice that if you go up, multiply by u, and down, multiply by d, that's multiply by ud, and if you go down and up, that's multiply by du, and because ud equals du, the commutative law of arithmetic, this is where my abstract algebra comes in, but it's a joke, because ud equals du, it will automatically recombine. And for anyone who wants to pursue this and build a Black-Scholes binomial tree, I want to observe that this is going to force the sigma, the volatility, to be constant throughout the tree because of this relationship. And we'll see shortly that it'll force some constant probability on you. So in a Black-Scholes binomial tree, you have these three numbers, u, d, and p, that are constant and create a constant volatility. But that's for another day. Okay, here's the fundamental principle of option pricing, in other words, of derivative securities pricing, and that is the no arbitrage axiom. The no arbitrage axiom basically says in efficient markets, no arbitrage is possible. And what is an arbitrage? An arbitrage is a trading strategy such that your probability of loss is 0 and your probability of gain is positive. And in a lot of arbitrages that you can think of, the probability of gain is 100%. So that's called free money. The no arbitrage axiom is sometimes expressed as there's no free lunch in the economy, or there shouldn't be. I just want to make a comment here that one thing that's really stunning to me personally as a mathematician is that if you take the axioms of mathematics and you add this one axiom, that there's no arbitrage in the economy, then all of a sudden, all of the results of financial engineering and derivatives pricing theory blossom out from that. It's just like a whole new field of mathematics, which I find quite wonderful. Okay, so here are a couple simple arbitrages just to get your head around arbitrage. So the first example is the most basic example, mismatched markets. So suppose the same asset, like the same stock or a commodity, is trading in two markets. These could be, say, markets in New York and London, or New York and Chicago. And suppose in market one, the stock, or whatever the asset is, has a $30.50 bid and a $30.75 offer. So these are market makers are basically announcing they're willing to buy for $30.50 and they're willing to sell for $30.75. And suppose in market two, the bid is 31 and the offer is 31 1/4. Well, you as a customer look at this and you say, oh, this guy is willing to sell to me for $30.75. This guy is willing to buy from me for 31. So I can buy here from this guy who's selling at 30 3/4, and I can sell to this guy for 31, and I make a quarter with no risk. That's a free lunch. That's an arbitrage. So that can't persist. And in today's markets, of course, with high-speed electronic trading, that almost never occurs. There are pockets of markets where you might see this fleetingly, but good trading firms will have computers ready to go after those opportunities and wipe them out in a second or less. A second kind of arbitrage, and this one is more important to us, this is quite fundamental, is what I call the two-portfolio arbitrage. Suppose you have two portfolios of securities, A and B. So these consist of, say, financial securities or other assets, and they're different. It's a different ensemble of assets. But suppose it is known for certain, it's absolutely guaranteed, that at some future time, capital T, the value of the first portfolio will exactly equal the value of the second portfolio. Under that circumstance, then the no arbitrage axiom says it must be true that they have the same value today. Because if they didn't, if let's say the first one is cheaper than the second, you would buy the first one, sell the second one, you make that difference in price, and at time t you can liquidate everything and the values cancel out. So that's a zero exchange. So you just made some free money right at the beginning. So they must be equal. Here's a quick example that is very useful in option trading. Portfolio A is going to be you're long a call option with strike K and maturity T, and these are going to be European style calls and puts. You're short a put option with strike K and maturity T, and you're short a no cost forward contract with forward price F and maturity T. A forward contract is another derivative security where there are no options. The buyer has to buy the underlying security, buy the stock if it's a forward contract on a stock, and the seller has to sell at maturity. There's no choice about it. These are always negotiated to have no cost, to have an initial price of zero, these contracts. Everything happens at maturity, and so that tells you what the forward price has to be. Okay, so that's portfolio A. Portfolio B is going to be a zero coupon bond. This just means a contract in which you're getting a guaranteed payment in the amount of F, the forward price, minus K, the strike price of the options, at T. Well, if you do the arithmetic here, the payoff from the call is the max of ST minus K and 0. You subtract the payoff from the put, which is the max of K minus ST and 0. That difference is ST minus K. And if you think about the forward contract, the value of that, the payoff is going to be F minus ST. And adding those together, this portfolio is guaranteed to pay F minus K at T. So these two portfolios have the exact same value at maturity T. And so by the two portfolio no arbitrage principle, they must have the same value now. Well, the value of this portfolio is the call minus the put, and then there's nothing. This is a no-cost forward contract. So the value of this portfolio altogether is C minus P, the call price minus the put price. And because the portfolio has to be equal in value to the zero coupon bond, that must be e to the minus RT F minus K, because the value of the zero coupon bond is just the discounted future cash flow. So this is a famous identity in the finance of derivative securities. It's called put-call parity. This is the most fundamental relationship about calls and puts. And in the marketplace, this can't be violated. If it is, you can make free money. By the way, that's another little joke here, is when I was a math professor, I worked with a colleague who always would come into my office and say, "Great news." I have a way of looking at this problem we're working on such that if we work this out, we either get a proof or a counterexample. Either way, we win. Well, I like to think of no arbitrage relations as the same thing. If there's no arbitrage, we get a formula. So we win, mathematically speaking. That's great. If it's violated, we make free money. Also good. Either way, we win. We get a nice formula, or the formula holds, or we get money. Okay. Fisher Black and Myron Scholes in the 1970s created the Black-Scholes pricing formula for calls and puts. And what they discovered in order to do that was this great principle, which is that by continuous delta hedging of options, you can do no arbitrage pricing. Now, what do we mean by that? Well, the delta of a call or put is its price sensitivity to changes in the underlying stock price. So literally, the mathematical derivative, if you think of the call obviously varies in price as the stock price varies through the day and into the future. And it's kind of a function of the stock price, and this derivative of the call with respect to S is called delta of the call. At any instant, it will have some sensitivity to the underlying stock price. And you can do similarly for the put. The put has a delta as well. Okay, so how does this work? This is the key to understanding no arbitrage pricing of derivative securities, and we're going to be focusing on calls and puts, but it's the same. And we want to think of it in terms of our binomial tree structure. So here's a big binomial tree, and I'm going to focus on initially talking about a European style call or put. So this is the payoff for a European call. You can do this with any derivative security with payoff f of st, but our example will be f of st is max of st minus k in 0. So notice, if you're looking at this, at maturity, if you get that far, and in European case you will, in the American case you may not, but if you get that far, and if it's European you will, then at the beginning, now, looking ahead in time, you know absolutely what the payoffs are going to be at all these nodes, all these future nodes in the tree. These are possible random values of the future stock price, and we know for each one of them what that payoff is going to be. So we have a fixed amount. We know what the call will be worth at these nodes. Now here's the idea. Suppose that in one time step that abstractly looks like this, a generic time step, we know what the values of the derivative security are going to be in the up state and the down state, one time step ahead. And suppose we could find the value here. Suppose we could say, oh, given these, we can infer what the value must be at this time step, at this node. Then notice that would allow us to start from the end of the tree, pull back one time step, and fill in this red dot. And we could use these two to fill in that red dot. We could fill in all the red dots in succession. And then, lucky us, we have two dots here. We could fill those in and keep going back all the way back to here, and then we would know the price today. This is called backward induction. It gives us the value now, and this is how you can price calls and puts using a binomial tree. Now I want to pause here and just observe one thing. I just talked about a European call. What if it's American? Well, we can do this with an American tree as well. And here's how that would work. If in an American option it hasn't been exercised by the time you get to maturity, then you know the two values there. You can infer what the value would be here if you waited one more time step. But then when you get here, you realize, oh, the call holder has the right to choose to exercise then. So what you would do is calculate, given the value of the stock at this red dot, you would say, oh, what is the maximum of that S minus K in 0? That's called the parity value of the option, the immediate payoff of the option if it were exercised then, and compare it to this value you would get by holding it for one more time step, and then pick the larger of the two. And so again, you get the hold value, and you compare to the parity, take the maximum, and that's the value you would assign to the derivative security there. And now you have values F up and F down for the derivative security at all these pairs of red dots, and you can go back to the next one. And you can do that all the way through the tree. So whether it's European or American, you can use the binomial tree to price the call or put option. Okay, so just to reiterate, we've just shown here that all we have to do is solve the one-step problem, the one binomial step problem, and then boom, we get the whole tree by backward induction. So now let's focus on the one-step problem. So I'm going to schematize this as the current stock price wherever we are in the tree. There's the up value of the stock, the down value of the stock. We've already gotten back to this time step, so we know the up value and down value of the derivative security, the call or the put, whatever it is. And I'm going to postulate a risk-free rate R, so $1 invested in a money market, assuming R is continuously compounded rate, will grow to e to the R delta t at the end of that time step. And we want to know the value of the derivative security at this node, at this starting point. Well, we're going to ask ourselves a question. It's called the replicating portfolio question. Can we find two numbers, delta and n? I'm sorry about using n here because I know I use that for number of time steps, but this is going to be a number of dollars. Can we find two numbers, delta and n, such that a portfolio of delta shares, so we're going to be long delta shares, and n dollars borrowed, so we've taken a loan of n dollars, will have the same value as the derivative security in both the upstate and the downstate? This is the portfolio A and B story. If we can find such a thing, then the derivative security and this portfolio have to have the same value right now. Okay, so that's the question. Now I'm going to rewrite the question in equations. So remember this picture. Okay, in the upstate, if the stock goes up, then the delta n portfolio would have value delta times S up because the stock price is now S up and we have delta shares. The loan value to us is minus n e to the r delta t because we have to pay that off with interest. The value of the derivative security is F up. In the downstate, the value of the stock and loan portfolio is delta S down because the stock has gone down, but the loan is still got to be paid with interest. It's still the same payoff, minus n e to the r delta t. And we're asking, can we make these two equations be true? That this is equal to F up, that's equal to F down. Well, this is two equations and two unknowns. This is like 8th grade or 9th grade algebra. We all learned how to do this back then. Sure, the answer is yes. That's the answer. So immediately, the two portfolio arbitrage says F has to be delta. If we know these, we figure out these numbers, it has to be delta times the stock price minus n. We are done. Derivative security pricing is over. Calls and puts are priced. And now observe what we didn't do. I never put any probabilities in this little tree. Never. Why? Because we're doing arbitrage between the stock and the option, the stock and the derivative. It didn't matter. The probabilities do not matter. They are irrelevant to the correct price. So it's not discounted expected value because there's no expectation here. This is just an arbitrage. We're arbitraging stock versus option. And they have to be in line with each other because we can trade both. If we couldn't trade stock, it would be a different story. Okay, I call this no arbitrage pricing formula number 1. It looks kind of simplistic, but incredibly, it's very general, which if you get more experience in this, you'll see. At any rate, the important point is the probabilities didn't play a role in this. Well, now we're going to audaciously go ahead and solve for delta and n. So this is just doing algebra. We're going to solve the simultaneous equations. Well, very quickly you can see that delta is F up minus F down over S up minus S down. That's nice because this is the delta. This is approximately, you'll notice, the difference quotient that would define the calculus derivative of F with respect to S. You take the difference in the F values divided by the difference in the S values. That's like derivative of F with respect to S. So that kind of makes sense. This should be like the sensitivity. So that should be the hedge ratio. Okay, and then a little more calculation and you get n is e to the minus r delta t times this quantity, S down, F up minus S up, F down, divided by S up minus S down. And now we're going to substitute these in to no arbitrage pricing formula number 1. I'm going to substitute those values of delta and n in here to get a formula for F. And here's what's going to happen. Again, you can finish the algebra, but here it is. It'll turn out very easily that F is e to the minus r delta t times, and I'm going to group the terms by the coefficients of F up and F down. The coefficient of F up turns out to be S e to the r delta t, that's the forward price by the way, minus S down over S up minus S down. And this one is S up minus the forward over S up minus S down. Those are the coefficients of F up and F down. And I'm suggestively going to call this P hat, and I'm going to call that Q hat. The hats are there to remind me that These are just artifacts of algebra, the algebraic calculation. There's nothing really special about them. They just pop out of algebra. Now, staring at this, the amazing thing is, if you look at this, you immediately see, oh, if I add p hat and q hat, the forwards, the SE to the R delta t's cancel, and I wind up with S up minus S down over, it's 1. Amazing. Unbelievable. It's kind of mind-blowing. They look like probabilities. Now you could get picky and say, well, how do we know that they're both positive? You know, that it's not a negative number in there. Well, another arbitrage argument says that S e to the R delta t has to be between S up and S down. And the reason for that is, if it weren't, then either the money market outperforms the stock in all cases, or the stock outperforms the money market in all cases, and you could borrow money and put it in the stock, or sell the stock and put it in the money market, and you win. So that can't be. So S e to the R delta t has to be between them. So these are both non-negative quantities. They look like probabilities. That's amazing. So in derivatives pricing, we call these the risk-neutral probabilities. They're the probabilities that come from eliminating risk by hedging with delta shares. In some papers and textbooks, they're called synthetic probabilities to emphasize the fact that they're not really probabilities. They're not the real probabilities. They're just artifacts of this algebraic calculation. And some people call them pseudo-probabilities. Again, emphasizing the fact that they aren't real probabilities. But with this p hat and q hat, we can rewrite the no arbitrage pricing formula to get formula number 2. In one time step, f equals e to the minus rt p hat f up plus q hat f down. And so this gives us a quick formula that's going to make our calculations in our binomial tree very, very fast. Okay, so generalizing this, if we look at a big tree with many, many time steps, hundreds of time steps, we have hundreds of terminal nodes. If you remember that Sij tree with the Pijs at all the nodes, if we trace through all the paths leading to a terminal node and add up the products of all those probabilities, we'll get the probability of that node at the terminal, at maturity, at the end of the tree. That'll give us the risk-neutral distribution of the terminal stock price. It'll be a discrete distribution on those hundreds of nodes. And we could use that to calculate the risk-neutral expectation, because we're using risk-neutral probabilities now, of the payoff. And this now will give us the no arbitrage price of the derivative security, the correct price. It looks like an expectation just by all this algebra. And that's great, because now we can think in terms of expectation, even though we know they're not really probabilities and it isn't really expectation. But this is brilliant. And this I call no arbitrage pricing formula number 3. It's risk-neutral pricing for, and in this case, I'm just doing this for a European-style derivative security, which is very simplified so that it's just the expectation of the terminal payoff. Okay, so now, at this point, when I present this to people, very often I get some pushback. I get pushback on a lot of points. One piece of pushback is typically, well, you know, maybe it's just that with stock prices, you don't really know the probabilities, so it's just a matter of knowing the right, you know, if you could really discover somehow what the true probabilities were, then it would be better to use them. I'm going to give you an example to debunk that idea. And I call this example the coin flip contract. So I'm going to postulate that there's a company, a corporation, that finances itself not by selling stock, but by selling what they call coin flip contracts. And the corporation has gone to great trouble and expense to manufacture a perfect coin, meaning a coin that is exactly 50% to be heads and 50% to be tails every time it's flipped. So the probabilities are always 1/2 and 1/2 guaranteed. And what they do is they announce that in advance that they're going to have a coin flip, a public coin flip, like every 6 months or every year, and that they're selling contracts based on that coin flip, and a holder of their contract will get $150 if the coin comes up heads, and they'll get $75 if it comes up tails. So they collect money for these contracts. Now, I'm going to also postulate that there's a secondary market in the economy that trades these coin flip contracts. So these are like the stock of the company, but they're constructed so that we definitively know the probabilities. They're a half and a half. That's the coin. It's guaranteed to be a half and a half. And I'm going to postulate that in the secondary market, the exchange where these trade, they're currently trading for $100. Okay, so this is our little numerical example. And just for ease of calculation, I'm going to assume the interest rate is 0, so $1 in the money market becomes $1. The forward price is then 100. 100 times SE to the R delta T, R is 0. Notice, by the way, the rapidity of the calculation. P hat is instantaneous here. It's 100 minus 75 over 150 minus 75. That's 1/3. So Q hat is 2/3. So we immediately get P hat. We know the risk-neutral probability of up and down. And now I'm going to try to use this to calculate the value of a 110 strike call. So the strike is 110. Notice that in the upstate, the 110 call will pay, well, 150 minus 110. This is ST minus K is 40. In the downstate, it'll be 0. So the two payoffs, F up and F down, of the 110 call are 40 and 0. So let's price this risk neutrally, in other words, the no arbitrage price. The call value is e to the minus R delta T. Well, that's a 1 because the interest rate's 0. P hat times 40, the up value, plus Q hat times 0, the down value. Well, P hat is 1/3, so it's 1/3 of 40, or 13.3333, $13.33, basically. By the way, the delta is also a very rapid calculation here. It's 40 minus 0 over 150 minus 75, or 8/15 of a share. Now, suppose that you decide, oh, no. The real probabilities are half-half. I know that, so I'm going to just price this realistically. It should be a half 40 plus a half 0, $20. And suppose you're willing to buy it for $20. If you buy the call for $20 from me, I'm deliriously happy. I'm going to hedge my position. I'm short the call, so I'm going to buy delta shares, or in this case, coin flip contracts. I'm going to buy 8/15 of a contract. Or we could do multiples of this to make them round numbers, but I'm just going to use 8/15. Now, in the upstate, what happens? If the coin flip is heads, I am long 8/15 of a share. The shares went up $50. That's going to produce $26.67 in profit for me. And I got $20 from you for the premium, because you sold it, you bought the call option from me for $20. So I have $46.67. I'm going to suffer a loss of 40 because I have to sell you a contract for 110 when it's really worth 150. So I have to buy a contract for 150, sell it to you for 110. I lose 40. 46.67 minus 40 is 6.67. What about in the downstate? In the downstate, I have a position of 8/15 of a share. I lose money, but I lose 8/15 of $25, the loss in the stock. Okay, that turns out to be 26.66, or excuse me, that turns out to be 13.33, but you paid me $20. I get to keep the premium. 20 minus that is 6.67. Notice I have a guaranteed profit of $6.06. Well, this would be 66666, but 6.67. Risk-free. That's an arbitrage. I've arbed you. What is your position? Well, if it's heads, you gain 40 from the option exercise. You paid 20. You gain 20 altogether. If it's tails, you lost your option premium. So you have either win 20 or lose 20. You have a $20 bet on a coin. It's risky. You have taken risk. You could win or lose. Now suppose you don't like that and you say, oh, I'll hedge too. Well, once you have bought this for 20, if you hedge, then you can figure this out. You've locked in a loss in either case of 667. That's the best you could do to mitigate your risk, is a guaranteed loss of 667. If you adjust the delta up and down, either you'll win more when it goes up and less when it goes down, and you'll lose more when it goes down, or you'll lose more when it goes up, or win more when it goes down, but you'll never eliminate the risk. The best you can do is guaranteed loss. So one last comment is, another piece of pushback I sometimes get is people look at this and they say, oh, I know the problem. The stock is wrong. They'll say, oh, if it's really 1/2 and 1/2 to go to 150 and 75, the average of these is $112.50. The stock should be trading at 112.50. Why isn't it? Human beings, well known, have what's called risk aversion. They hate losses more than they love gains. They hate to lose, and because of that, since this is risky and it's not a risk-free bond, if they were to buy this for 112.50, the net return would be the same as the risk-free rate. And if it's risky, they don't want to spend as much for it as they would for a risk-free bond or a money market investment. So they say, no, 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 that's too risky, I'll pay less. And the risk aversion is reflected in this lower price. This is the beginning of option pricing theory. You can see how it's really no arbitrage pricing. That gives you the correct price to trade at. And it can be achieved through using risk-neutral probabilities, risk-neutral distributions, this no arbitrage argument. That's all for today. Thanks for watching. And if you'd like to see some of my other lectures, they will be posted on Susquehanna's YouTube channel. Thank you.